is Florence Eaves, and I am a realtor with Keller-Williams Chvernic in the Akron, Cleveland area here in Ohio. I'm sitting here today with Devan Maxwell with Union Home Mortgage. He is a lender in our area, and he is here to help explain all the different ways getting pre-approved helps and what it means to help you reach your goals. Before we get started, I do want to take a moment to thank American Title Solutions here in the Akron area for hosting us in their media room. All right, let's go ahead and get started. Devan, how long have you been in the lending industry?
So I started out in the banking finance industry for about 7 years. Then I transitioned over into the real estate industry, and I've been in lending for 2 now. So
how do you enjoy working with different people to help reach their home goals?
it's fantastic. It's the passion that I have for the industry, and just helping people attain the goal is really the end goal. Finances can be scary for a lot of people, so being able to be that backbone and the resource to answer any sort of questions, especially for first-time home buyers, is very rewarding.
I can understand that. I think it is great that you enjoy what you do. I thoroughly enjoy what I do as well. And we are here to basically help clear the air because I get a bunch of questions as a realtor. I get questions about every single job title in the field. But unfortunately, I'm not an expert, which is why I have brought Devan here today so that people can understand the difference of our roles as a realtor and he as a lender. He would be your finance expert, and I would be the housing expert, technically. All right, we can go ahead and get started. I have a few questions loaded up. All right, Devan, tell us the first step to buying a home.
So the first step and the key step is getting pre-approved. Knowing your purchase power heading into it is really the determining factor as to how your home search is going to go. I know a lot of people, are sitting at home and it's super easy to jump on Zillow and just start browsing, but don't fall down the rabbit hole too quickly. A lot of people tend to, and then they fall in love with homes that they maybe can't yet afford or need to talk to a lender and figure out, what exactly that purchase power is so that they can have a reasonable headspace for what's attainable for their budget.
So the first step is basically setting your budget and making sure your eyes aren't bigger than what your budget actually is.
Exactly, yes. It's very easy to start looking at those $1 million homes and what you aspire to get into. And oftentimes, especially depending on the area, you really want to just know what you can comfortably afford before you start falling down the rabbit hole and just looking at all those $1 million listings that are out there.
Yes. And I think that starting with planning your budget first actually saves you and your realtor even a lot of heartache and back and forth and going down the path, just because when you start with a plan, you can actually hit your end goal. So Devan, if I had a friend who was interested in buying, but they think that, hey, it's going to be at least 6 months, maybe 12 before I'm actually ready, how soon would you say they should have a conversation with the lender?
So there's really no such thing as too soon. I really advise people, as soon as you kind of get that spark and that interest to get into the market, to go ahead and reach out, or if you have a realtor that you plan on using, ask them, who they're comfortable working with or have had experience working with in the past. It's really good to know up front your game plan. So a lot of people, especially first-time home buyers, don't really know what all it takes or what all is considered when getting pre-approved. So the sooner you reach out, you can really start having that conversation about your finances, what maybe your debts look like, your household income, and then really start to get a gauge on maybe some credit repair fixes you can get handled before actually filling out that application, or maybe saving up for a down payment. Really just depends on the price point you're looking to purchase at, and how much homework you've done ahead of time as far as savings and credit review go.
Awesome. So it truly is never too early to reach out to ask your questions.
Yeah. So I always say 6 months if you're a planner, That way you can kind of get ahead of it. But 3 months is kind of really that sweet spot because it takes a little bit of time, especially for buyers to gather their documents for pre-approval and things like that. But it really gives a lender a good window to review your credit profile, kind of give you a heads up as to what you might need to work on to really hit those certifications and qualifications that you need for specific programs you might be interested in.
Awesome. Thank you for that. So something that seems to be common amongst the general public is that the idea that applying for a loan to buy a home is a long, drawn-out, scary process.
Yeah.
I want you to tell us about what that process actually looks like. Is it a fact that it is long and scary?
No. So that is definitely a myth. It's only as scary as you make it out to be. Really, just having that initial conversation with your lender will give you a lot of clarity. And then through the pre-approval process, it's all really going to get drawn out just on how quickly it takes the client to get their documents together. Us as the lender, we need the documents to be able to build up your file. So if you have them all at the ready and you can submit them over to us, it's really not a quick it's not a drawn out process for you to get that pre-approval. We just have to be able to look at your income, your assets, your credit, and cultivate that file for you. And once you kind of get the green light from us, you're good to go. We'll send you that pre-approval letter and you and your realtor are good to go home shopping.
Okay. So if all the files are turned in a timely manner, say we reach out on a Thursday and after the initial conversation, you talk about their plans and goals and tell them everything that they need to turn in, and it gets turned in that Thursday.
Sure.
How soon could they possibly be pre-approved?
So if they have all of their documents, I can normally get a pre-approval out personally in within 24 hours.
Okay.
However, it really depends on the applicant. If it's just standard hourly W-2 income, those are the easiest because it's all in black and white there. If it's something like overtime income or bonus income, those are things that can vary, obviously, and so we have to get a department called Income Desk involved, and so they have to kind of figure out that calculation. They take an average over your last 2 years, figure out what we can actually use to help qualify you in the file. So that can take anywhere from 24 to 48 hours, just really depends on how backed up the department is. So I like to say anywhere from 1 day to 2, maybe 3 at the absolute most.
Okay. So not long and scary at all.
Not long and scary at all, no.
It's just
as long
sitting
as
there.
you're prepared.
Yes, being prepared and asking your questions.
Yes, for sure.
Awesome. So we are here because there are planners out there who might be a little nervous about having that conversation.
Yes.
What costs should people be prepared for when they are starting the process of buying a home?
Sure. So down payment, for sure. All depends on the loan program that you're qualifying for, but having a lump sum for your down payment, something that a lot of people actually don't think about is your closing costs. So there are fees that are associated with obtaining your loan and getting it to the closing table, such as title fees, but then also another figure to be aware of is your appraisal and your inspection. So those are things that you're actually going to pay for out of pocket through the process. So once you get under contract, you are going to have to get an inspection, usually, done on that property, and that's something paid for out of pocket. And then afterwards, if you do have to get an appraisal for the home, you do pay for that out of pocket as well. So that can vary depending on the third party that you get to do those services for you. But that is, especially for first-time home buyers who have never been through the process, that's something that, they don't think about because you don't know what you don't know.
You don't know what you don't know. That is absolutely right. All right, so let's go ahead and get down into the nitty-gritty. We're going to talk about the different loan types. Can you tell us some good things about using an FHA loan?
Sure. So FHA loans, 3.5% down is that standard. And then they can often be paired a lot with down payment assistance and grants. Really, it all depends on your locality and where you're looking to buy. Also, the state that you're in can have different programs available for buyers. And it's all based on each buyer's specific situation, their qualifications, their income. A lot of down payment assistance is based on area median income. So it depends on what area you're looking to shop in. But FHA loans are more easily qualifiable. They have lower credit score standards, so 580 is about where you start for that, and then the 3.5% down.
Awesome. And tell us about the difference with a conventional loan.
So conventional loans, qualifying for those, they're a little bit more lackadaisical when it comes to requirements, especially when it comes to appraisal requirements for the loans. So the debt to income ratio for qualification for a conventional loan starts at 45% or less. And then the credit score for that is you need a little bit higher of a credit score to qualify. That's at about a 620. And conventional loans are a little bit more user-friendly because when it comes down to an appraisal, they're not as strict as like FHA. FHA is a federally backed government loan, whereas conventional is provided by like investors and therefore aren't government backed. So they have a little bit less stringent qualification standards than a government loan would.
Okay. Thank you for that description between the FHA and conventional. Now, we know that there also is a VA loan option as well. Could you tell us about that?
Yeah, so VA for Veteran Affairs, those are available to veterans, surviving spouses, retired veterans, obviously, and then active service members. Those are 0% down loans. So a lot of people think about those when they're thinking about not putting anything down, as long as they qualify for it. But they are available for veterans and service members. The debt to income ratio for that is 41% or lower. And they don't technically set a standard for the credit score minimum, but for approval and for risk factors for the lender, it's normally 500 and above for consideration.
Awesome. Sounds like a very flexible option for folks. And last but not least, tell us about the USDA loan option.
Sure. So United States Department of Agriculture is what that stands for. Pretty similar to veterans, but you don't have to be a veteran to necessarily qualify for that. 41% for your debt to income ratio. The credit score requirement is the highest out of the 4 options. It is starting at 640. All of these programs are a little bit flexible on the both debt to income and credit score. It really just depends on compensating factors. So as long as you have good credit history, repayment history especially, your income is stable and secure, things like that are those compensating factors lenders will look like if you're kind of just on the cusp of those standards.
Awesome. Now, we were able to review all the ways these loans compare. Could you tell us whether or not all of the loans have different interest rates?
Yeah, so the interest rates do vary a little bit. I would say conventional is normally slightly lower than FHA, but the market always varies. So things are always ebbing and flowing. Rates change literally daily, so it's always best to reach out to your lender just to ask. We can easily look that information up for you, but the rates also rely heavily on the qualification standards.
Okay.
The better credit you have, the less debt you have, the better repayment history, the lower rate a lender is normally able to obtain for you. So it's all pretty dependent on each client and what they bring to the table when they're applying for the loan.
Right. So if that client reached out ahead of time and prepared their background, their financial background, they would be able to put themselves in a better position, obviously,
exactly.
with more planning.
Yes. Yeah.
Awesome. In current times, we have a lot of folks out here who have very untraditional financial backgrounds because people are working for themselves more often than not now. So if someone is self-employed, what does it look like applying for a loan? Can they still apply and get approved?
So yes, there are what are called non-qualified mortgage programs that are available if you don't qualify for those traditional programs that we just went over. So there are 1099 programs for self-employed borrowers. There are programs for investors if they're looking to expand their portfolio called DSCR loans. There are foreign national programs if you're here on a visa. So really depending on the lender that you choose and their access to different loan programs, you can get access to these non-QM programs and qualify. So really ask your lender what other sort of loan options are available for you that they can provide if you, for whatever reason, don't feel that you're going to fit into the mold of a traditional financing option.
Awesome. And it sounds like we cycle back to the first question, which is make sure you have that phone call
Yes,
or that conversation with
Definitely
the lender.
have that consultation.
Okay.
Yeah.
let's talk about down payment assistance.
Okay.
Is it possible in the state of Ohio to qualify for down payment assistance? Is that something our state offers?
Yeah. So again, it's really just going to depend on the locality and the state that you're in. A big one for Ohio is it's called OFA, Ohio Housing Finance Agency. That provides a 3% to a 5% down payment assistance. It goes on your mortgage as what's called a second lien. So it's its own kind of subsidized loan right off of your initial mortgage as to what you're borrowing. So, but those funds can actually be used to pay for your closing costs, your down payment, and all of those fees that go into actually qualifying and closing on one of the loans. They do come, as a second lien, they do come with terms to them. So for OFA, it is a 7-year, kind of like a payback penalty. If you were to relocate out of the home within that 7-year period, that certain amount that they give you, the 3 to 5%, becomes payable. So that's normally not an issue, especially if you've lived in the home a little bit and you gained some equity, and if you are looking to move before those 7 years, you've normally gained the equity, or you've saved up a little bit, or you're going to get the proceeds from the sale of a home if you have a great realtor. So you will recoup those funds in order to be able to pay that back. So that's a conversation that I have with my clients a lot. A lot of them don't really know what a second lien is when they're getting into all of this. They're just more interested in the assistance, so you just kind of got to let them know what that fine print reads, especially when they're looking to qualify for it.
Okay, so with that down payment assistance, you would, if you moved earlier, you would owe money for it. But there's also grants as well for down payment, correct?
Yes, yeah.
Could you tell us a little bit about qualifying for one of those?
Sure. So each lender will also have their own grant program as well. So again, really depends on who you're choosing to go with as your lender. It's always important to kind of ask around and shop a little bit, just to see what your options are out there. But every lender should have like a grant program in-house, especially that is just money that they're willing to give you for using them, as long as you meet the qualification standards. So those are going to vary depending on the lender, depending on the program. So again, another reason why you should talk to your lender up front, and so that they can kind of assess your current situation and see what programs might be eligible for you.
Awesome. Thank you for that, Devan. All right. All this talk about mortgages, let's get into what is actually included in a monthly mortgage payment. Could you tell us something about that?
Sure. So we like to use a little acronym called PITI, P-I-T-I. So that's going to stand for your principal, interest, taxes for the specific property you're purchasing, and then insurance, so that homeowner's insurance that you're getting. So those four are going into what you're paying in your monthly mortgage payment. Principal being the actual loan amount that you borrow from the lender, the interest, that interest rate that you're qualifying for and getting locked in once you're under contract, taxes, which are going to vary for each and every property that you're looking at, and then the homeowner's insurance, which the buyer themselves can actually shop for and then notify the lender who it is that they're going with. So depending on all those figures, that's what all comes together to make that initial mortgage payment.
Awesome. Would have never known that it was anything other than the
Just
house
that
payment.
mortgage, right.
Okay. So we know that there is a difference between loans in the sense of having an adjustable rate and a fixed rate. Could you tell us the difference between the two?
Sure. So a fixed rate is what you're widely going to see in the market. That's typically used for like primary homes and first-time home buyers just purchasing their primary residence. With a fixed rate, it is exactly what it sounds like. You are locked into that rate for the entirety of your loan, that whole term. So even if the market fluctuates, your rate will stay the same. It's pretty reliable. Your payment's going to stay the same. It's more predictable for the borrower once they get locked in with a fixed rate. So a lot of benefits if you need that stability. Whereas it differs with an adjustable rate, it is, again, just like what it sounds. It's going to adjust over a certain period. So adjustable rate mortgages, or ARMs is what we call them, they are normally represented by a fraction. So for example, a 5/6 ARM is going to be a interest rate that is locked in for an initial period. So in the example, it's going to be a 5/6, so that initial rate's going to be there for the first 5 years of the term of your loan. And then after that initial period is over and that 5 years lapses, it's going to adjust for every 6 months, if we're using my example. So that's where the 6 comes in at the bottom of the fraction. So that is more beneficial for home buyers who may be relocating, or investors who might be wanting to purchase a home and then sell it later on. Those are the ones who really benefit, because a lot of adjustable rate mortgages, you can secure a lower interest rate for that initial upfront rate. However, if you do stick with that property for the entirety of the initial front term for that rate, you just have to be wary about how the market adjusts.
Okay.
So as that 6-month period kicks in where everything's adjusting, rates always fluctuate. So it could be an unpredictable rate. You might be in with a higher rate than what you initially started with. So a little less predictability there, a little less stability when it comes to the payment. And then a lot of people actually get out of those ARMs by refinancing. They'll refinance that ARM loan into a fixed rate loan. But if you're sitting and you're waiting too long, when you refinance, it has to be based on the market. So interest rates could increase again, and you might find yourself with a higher interest rate than what you initially started.
Okay. So making sure to ask those questions would be very helpful to know what you're stepping into. So once the buyer gets pre-approved and we're out shopping for a home, we find the one, and it's time to submit an offer to purchase that house. Is it good practice to reach out to your lender before submitting an offer to purchase any home?
For sure. Yes.
Okay. And could you tell us why it would be helpful to do that?
Yeah. Like I said earlier, property taxes, which go into your overall mortgage payment, vary property for property. So to let the lender know ahead of time that you're thinking about writing an offer on the home, the lender can actually go onto the county website, figure out those taxes, plug it into your loan file, and give you a more accurate monthly estimate for what that payment's going to be for you. That way, you can double check that you're comfortable paying that if it is the dream home, and figuring out, how to structure that offer to make sure that you are maintaining, your budget and your comfortability with the payment.
And that actually leads me to our last question. Can you share with our guests what makes a lender like Union Home Mortgage or a general retail lender different from a bank like Chase or Huntington?
Sure. So our access to products, typically, we have a wider variety of products we can offer our clients because it is something that we specialize in. A bank has a wide variety of products, but they're not all tailored to mortgages. So I like to say they kind of scratch the surface of products, whereas when you're going with a lender specifically, where all we do is lend in mortgages, we have a very in-depth concept and access to different loan programs that we can get you qualified for, different down payment assistance, and you can contact us any time of day. A lot of the issues clients run into when they go with their bank, even though they might have banked with them forever and have a long-standing relationship, is they can only access them between 9 and 5 and can't on the weekends, so they can't get their questions answered. Whereas if you're working with a retail mortgage lender, that loan officer is always working. So we work well into the night, we work on weekends, we will always pick up the phone for you and get you those answers that you're looking for.
Awesome. And that actually is very important, making sure that you are working with a professional who acts as though they are a professional and would like to help you reach your goals. It's also important to realize that you will come across a handful of different professionals when you're going through the process of buying or selling your home. And we all play a very specific role in the field, and our end goal is always going to be to help you reach your end goal. So thank you so much for taking the time to sit down with me today, Devan, and tell the folks about all the ways getting pre-approved can be very helpful, and also the way that you can help them along the way.
Yeah, thank you for having me.
Thank you.